Hey everybody, welcome to day 4 of our first ever Wellbeing Week. We've talked about a lot of different topics this week, from physical wellbeing, wellbeing in the workplace, mental wellbeing, and this week we're going to be, today we're going to be talking about financial wellbeing. I head up the Next Generation Business Chamber, and I'm delighted to be joined by 2 of the members of the chamber today, talking about financial wellbeing. We've got Paul Stevens from Sanlam, and we've got Alex Stennings from Vintage Financial Planning. And I'm going to pass over to Paul in the first instance for him to give us some wellbeing tips about our finances. Over to you.
Brilliant, thank you, Amy. Right, let me attempt to share my screen. Perfect. Hopefully you should all be able to see a presentation, which is great. So good morning everyone, thank you for joining us. The current pandemic has taken its toll on everyone, and so today what we wanted to do, as Amy mentioned, is talk about the financial side of things and take a look at financial well-being. We know that people's financial situations are inextricably linked to their mental health. And so while some of the sessions earlier in the week have spoken about mental health, we feel that people with financial worries are more likely to suffer with anxiety, stress and depression. So it's worth touching on this topic as well. And what we wanted to do was provide an opportunity for anyone to ask questions that they may have about any part of their finances, and both Alex and I can try and answer them ourselves. And if we can't, then we can triage those questions and advise you where to go to find help. I'll talk about a bit about investments. So obviously that's my background as an investment manager, and the importance of investing. I promise it won't get too heavy and technical. And then Alex will look more at mortgages, various forms of protection that we can put in place to protect our finances, and then budgeting in times when income may be tighter than it has been in the past. So first of all, let's have a look at what's going on, what's been happening in markets, what's been the impact of this coronavirus pandemic. Most people here, or most people listening, will have been exposed to the market moves over the last few months, whether they know about it or not, possibly through their own personal investments, ISAs and things like that, but almost certainly through their pensions. So if we have a look at what's happening and why, and then we can look to see how we should approach investing going forward, particularly during such times as this, where there's a clear crisis, economic and market crisis has been taking place. So a bit of a history lesson. January 2020, markets are hitting all-time highs, particularly in the US. Donald Trump, although being bonkers, has been very pro-business in a lot of his policies, and he's created a lower tax environment for businesses to operate in. Every now and then there's a tweet that causes the market to wobble, and it blows over because the central banks have got interest rates very low and are supplying the system with lots of money, and things soon get back on track. And in January 2020, the biggest risk out there is that businesses fail to deliver the profits that the markets are expecting. That's really the big risk that a lot of investment people are seeing, is the market overpriced. Also, around or shortly before January, there was this new virus that was grabbing some headlines in a place in China that no one had ever really heard of, but no one was really taking much notice of it. It was very much something that was happening over there. Skip forward 4 weeks and enter February 2020, and COVID-19, as it's now called, reaches Italy, and the world literally starts to melt down. Global markets enter free fall. The FTSE 100 dropped 33% in 22 trading days, and the Dow Jones, which is the main US index, or certainly the headline one, fell 20% in just 20 trading days. And to put that into context, past falls of this magnitude, particularly in the US, have taken an average of 255 trading days. So this was something that was incredibly unprecedented. It happened very, very quickly. And if we consider the financial crisis, which is the last market crash everyone associates with, that played out over a number of months. This was literally 4 weeks, boom, the market fell. And it fell on the fact that there was fear and panic that the global economy was going to shut down. Businesses would go bust. No one would ever use a plane again. No one would ever go to the cinema, and no one would buy things from shops. Everything was going to close. Capitalism was broken. But government stepped in, they provided support for workers through increased spending, tax breaks for businesses, and central banks cut interest rates to zero and pumped huge amounts of support and money into the system. And this helped companies to survive. They simply were able to pay their bills and carry on being in existence. And as almost as fast as the market fell, it came roaring back. And in fact, this week, the Dow Jones that we mentioned fell 20% in just 20 days, touched all-time highs of 30,000, the level of the index. And you can see on this chart that you can see the dramatic fall that took place just into the new year, but then also the equally dramatic rise. And when you look at where we start, focus on the dark line here. I've pinched this chart from somewhere else. The light blue line is just a different way of representing the same data, but you can see that basically we're back in a broad market term to where we started the year. But what really is different here is how the recession was unique in some ways, in that usually when you have a recession and a market crash and the economy is in real trouble, everyone suffers. No one's spending, maybe levels of debt are too high, and there is very, very few hiding places. What was unique about what's happened over the last few months is the degree to which there have been winners and losers created. So technology stocks have really provided the hardware and software to enable huge amounts of the global population to work from home. They've obviously been massive beneficiaries, as have those companies that have helped us to facilitate our life at home, such as online retailers, Netflix, Google, Facebook. All of these people have been huge, Zoom in fact, have been huge beneficiaries of us staying at home, and their share prices have absolutely boomed over the last 9 months. Something that you very rarely get in a recessionary market crisis environment. In contrast to that, many of the companies and sectors that rely on people going out, continuing to carry on their lives as normal, they've continued to struggle, and they haven't seen the recovery that the other sectors have. So weak demand in the requirement for oil has seen energy stocks lower. We've seen general retail shops suffer, entertainment stocks, plane stocks, hotel stocks, you name it. If it's something that we were doing normally and we couldn't do from home, they haven't recovered as well. And in fact, that can be highlighted by this next slide, which is from JP Morgan, which shows that the US, which has the largest weighting of technology, online retailers and online advertisers, has really outperformed, which is the green line, the rest of the world. And so the US is higher than when it started the year in terms of the broad market index, whereas most other regions are seen some modest recovery, but they're broadly flat since maybe sort of the end of May. You'll see at the very end that with the vaccine news that came out recently, there's been an uptick in some of these unloved names. Investors are starting to see light at the end of the tunnel, and some of the sectors that were hardest hit have started to recover, but there is some way to go. So there are opportunities there, but on the whole, the bounce back has been fairly strong. So I guess what the message here is that a lot of things can happen in the market over the short term, but what we need to focus on is the long term. That's the most important thing when we're investing. You need to have a lot of time to dedicate to researching and trying to call short-term market moves, and for most people, they don't have the time or the inclination, and even when they do, they often get it wrong. I mean, who would have predicted that there would have been a 30% fall in the FTSE followed by a huge rebound? Who would have predicted that the US would have been higher now than it was pre-COVID? There's a lot of unknowns out there. But what we do know is the markets tend to trend up over time. So the longer your time frame, the more blips like this are smoothed out. And it's this long-term time horizon that we need to keep in the front of our minds when we're talking about investments. And then we need to take a step back and say, what is it we want to achieve, and not be blinded by the chaos that's going on around us in terms of the markets. What are our personal achievements and goals? And that's why setting goals is important. That's probably the first sort of tip from today. It's important that you identify what you want to get, where you want to get to, how much it's going to cost to get you there, be that a retirement plan or a spending goal in the future, and then what is the gap that you need to fill. And this will help to create that mindset of achieving that goal. So I need to be aware that I need to create this much wealth, or I need to be able to save this much for X number of year time and you can create a mindset as to how you get there. A common rule of thumb is often called the 50-30-20 rule, which is quite common out there if you've heard these sort of things before, where it says 50% of your annual income should be spent on things you need, 30% on things you want, and 20% should go towards savings and investments. Another common one is specifically on pension saving, often hits mainstream media news articles, which says that you should be saving a percentage of your income that's the equivalent to half the age at the point you start to save. So if you start saving into a pension when you're 28, then you should be looking to save 14% of your annual income into that pension each year. Obviously, the advantage is here: the earlier you save, the less you have to save on an annual basis. But there are only rules. They're the rules of thumb. They're not hard and fast. You must obey, you must save this much, and everyone's different. But it's important to remember that we should consider saving at some point in order to reach those goals. And that's really highlighted by a bit of research that Fidelity did in 2016 that showed if you placed a deposit of £10,000 in the average UK savings account back in 1986, in 2016, it would have been worth £28,000. If, on the other hand, you had invested the same amount in the FTSE 100 in general, so bought a tracker or a little bit of every company in the FTSE 100 and reinvested your dividends over that same 30-year period, it would now be worth £126,000. So you can see there's a real opportunity cost for not thinking about investments in the long term, and holding everything in cash you can miss out quite significantly. But wait, you just said that the markets have bounced back and surely now is not a good time to invest. The question, should I wait for it to fall again? Well, the next slide, investing in a crisis, is basically me trying to say, try not to worry about where the market is now. My first point there, time in the market is much more important than market timing. Much like buying a house, people on the whole don't say, I'll wait to buy a house when the market's fallen or when the house prices are cheaper. They buy when they want to move, and they buy when they need a house. And we should view this in the same way when it comes to investing. Invest to achieve our goals. Because although markets have hit all-time highs and people are saying there's still risks out there, I've already highlighted there are some deviations in the sort of opportunities out there. Some companies are still unloved, some companies are overloved. And that's where an investment professional can come in to try and help pick those. But in general, we invest to achieve our goals, so don't worry about when to start investing. Now is the best time to start investing. Also consider where interest rates are, all-time lows. So you get nothing for your cash at the moment. And if we consider that or that previous example from Fidelity, £10,000 left in an average bank account for 30 years turned into £28,000. But if you consider a huge swathe of that period were the 80s and 90s, particularly the 80s, where interest rates were above 10%, and now they're nothing. So even with really favourable interest rates, the return on investments were much, much better. And over that time frame, there were also market crashes. So we had the tech crash in the turn of the century and the 2008 financial crisis, and still the market was able to return you attractive returns over the long term. But it is important that we maintain diversity, so don't put all our eggs in one basket. Part of the reason we're able to say invest now and don't wait is because by investing in a diversified portfolio, you provide some protection to yourself, because you're going to there will be winners and losers, and so you can dampen out some of the impacts of those shocks. And then finally, and this is where maybe an investment professional comes in, be clear about the difference between your capacity for loss and attitude to risk. Capacity for loss is very much, how is my life going to be impacted by a fall in the value of my money? Can I afford to lose a portion of this money or see the portion temporarily fall? And attitude to risk is, how do I feel emotionally about the value of that money? How will it provide me with sleepless nights if I can't see my portfolio growing? Will it provide me with sleepless nights if I see the portfolio fall in value? And it can work both ways. You can have a high attitude to risk, so you can be really, really keen to take risk and enjoy the buzz of seeing the portfolio move around. But if you don't have the capacity, then it becomes a problem. And vice versa, you may have all the money in the world to invest and not a care if it were to halve or lose all of its value. But from a financial point of view, but if from an emotional point of view, you hate to see money go down, again, that works against each other. So it's about striking a balance between what you can afford to take and what you're willing to take in terms of risk. So where to start? First of all, don't be afraid. Think about if your current saving strategy is sufficient, and are the assets that you have working for you are they working for you in the best possible way? Again, yeah, don't be afraid. Make use of pensions and seek advice. Rarely do governments give money back, but when they do, we should take advantage of it. I can't personally advise on pensions, but they are worth investigating and seeing what your arrangements are. The same with ISAs. Again, it's a tax efficient investment. Take advantage of that. With the potential changes that are coming up in the budget post lockdowns and coronavirus, there will be increases in taxes. So if we can make the use of these allowances, it's the best thing to do. Capital gains tax is one of the areas that's going to be in the crosshairs immediately. So again, ISAs help to protect some of our assets from that tax. And most importantly, start now, boost that emergency fund and provide future reassurance and protection for yourself should something like this happen again. But even if you feel, well, I started a pension years ago, it's never too late to review. It's never too late to start saving, and it's never too late to review what your options are, what your strategy is, just to make sure that everything is humming along quite nicely for you. So that's very much my sort of thoughts about why we should be investing, the importance of investing. If you have any questions, I'll leave them to the next actually, because there's one other thing I want to talk about, and that is investment scams. We've never been in a period of time when there are so many uncertainties and people are taking advantage of those uncertainties. Even experienced investors can fall victim to scams. The use of social media and the increased use of email, particularly with us being at home, has increased dramatically. Scams usually involve a cold call or some sort of unsolicited invitation to invest in a product that's either worthless or doesn't exist. Usually they're offering high levels of return for very minimal risk or minimal outlay. Another common scam or attempt of fraud is phishing. This is where people will send emails and try and trick you into logging into what you think is your account, but it's not actually, it's their software, and they're trying to glean information from you to be able to access your account. And every day Gmail blocks 100 million phishing emails, and a further 240 million COVID-related spam messages in more recent times. So it's something that's a huge issue, and people should always remain alert over that. And then pension freedoms. Pension freedoms were introduced back in 2019 to give people greater access to their pensions and the money held up within them. But it's also created an opportunity because if people can take big lump sums out of their pension, then it leaves them susceptible to a fraudster trying to gain access to that. So some important things to remember. Some of them they'll sound very obvious, but it's always worth reiterating. These are very important things to help keep you safe. Restrict sharing your personal information. Obviously, the fewer people that know your login details or personal information about you, the less vulnerable you are to being a victim of fraud or a scam. Critically analyze any investment relation communications that you get. Check the usual things when receiving funny emails. Check for grammatical errors, inconsistency in fonts. Check the email address that it's being sent to. After the @ sign, it should be the company website that they're claiming to be from. Check those. The easy way to do that is to click reply to the email. It will open up a new email with that email address in. Alternatively, you can right click on the email address and then see what the underlying root email address is. If it looks suspicious, ignore the email. Have strong passwords. That's also something that I think people don't do enough of. We have password for everything nowadays, and it's quite common that people pick easy passwords that are very easy to crack. Strong passwords, alphanumeric and characters. And also use multi-factor authentication when you can get it. It helps keep things even more secure. And one of the most important things that we would advise to clients is keep your email password unique. So don't use your email password for anything else, because if they crack your email password, then they've got access to everything else. So a unique password for your email, and then you can do other things with other passwords. The next thing I've mentioned is report it. So if you become a victim of this, or you suspect you're becoming a victim of some sort of investment scam, report it to the police using actionfraud.co.uk. They can take you through the steps on that website. Ignore unsolicited offers, particularly those on social media. Never respond to any requests to send money. Always make sure that it is a legitimate investment opportunity first. And that's really where the last point comes in. Check the FCA register. Are they regulated by the FCA, the Financial Conduct Authority? If they're not, probably it's something dodgy and should be best avoided. So they're just a few things about scams I feel are important in the current time. But most important of all was start thinking about investments now. Where am I going? Thank you. Let me stop my screen share.
Paul.
Yeah, thank you. Any questions?
I made a couple of notes as we were talking, because the CGT changes are quite prevalent at the moment. There was a big report published the week before last, which was about 120 something pages about changes to capital gains tax. So I just wanted to echo what you said, Paul, about reviewing investments at the moment. And also about a year ago, I started doing the 50-30-20 rule, and it's fantastic. It's a really, really good tip. So thank you for sharing that with us today.
And also, just to come back on the 50-30-20 rule, remember with pensions as well, there's potentially some the tax that you get back will contribute to that 20%, and any contribution contributes to that 20% as well. So they're quite a powerful tool.
Yeah, it's a really simple ratio to remember, but it actually makes really significant difference. And when you were talking about somebody getting the buzz from seeing their investments grow, actually just applying something as simple as the 50-30-20, you get that buzz seeing your nest egg grow and your slush fund for personal expenses growing. So it's a really, really useful tip that I would recommend to everybody that's listening and watching. So thank you for sharing all of that with us. And we'll now hand over to Alex.
Hello, good morning, everyone. It's been a great couple of days, and I'd like to thank everyone again for hosting it and stuff like that as well. So yeah, my focus of the talk today is to talk about mortgages, protection, and a little bit of budgeting, really. So as you very well know, 2020 has been a really difficult year for a lot of people. But for some people, it has been worse than others. And I know a lot this week we've been talking about mental health and everything else as well. And the impact on people's finances is one of the biggest reasons that causes a lot of people to kind of suffer from stress, anxiety, not sure, not knowing, where the next paycheck's coming from, how are they able to pay the bills and stuff like that as well. Whether you're running a small business, you're self-employed, or even if you've been furloughed, you've suddenly, over a period of this year, many of us would have seen either a dip or a sudden cut in our income. And so really, it's just a little bit of a summary to talk about some of those areas and how we can mitigate that and at least put you back in control of that. So many people here today may already have a mortgage, have always paid on time, never had any issues at all, and that's great. But then may found themselves struggling to be able to pay. My best advice is always to pick up the phone and see what your lender can do for you. Lenders are much rather that you'd be upfront with them, much rather that you talk to them and say, look, things are a bit tight at the moment for X, Y, and Z. Is there anything you can do to help me maybe, I don't know, pay interest only for a few months, maybe have a deferred period in terms of the mortgage payments? They'd much rather you do that than you letting the issue sit, you miss a few payments, and then it just causes more problems further down the line. So it's always best to get ahead of the issue, because at the end of the day, it's the lender wants to ideally keep you paying the mortgage, and it's much harder for them to try and get the money back by selling the house. It's a lot more effort for them, so they'd much rather engage with you and see if there's anything that they can do with you. One of the things you might have seen a lot in the news is things about a mortgage holiday. This has been extended for another 6 months in the beginning of November. I do object to the term of this term holiday being used. It isn't really a holiday. Interest on your mortgage will still accrue over those few months. So you will end up paying back more over the long term, which again, I think the word holiday suggests that they're just saying, oh, it's fine, you know, we'll give you a couple of months, don't have to worry about it. But no, there are consequences to it. But yeah, if you need to make use of that facility, or no one that does, you know, speak to your lender and stuff like that as well. Although having a mortgage holiday doesn't affect your credit report and your credit scores, which is always good news, it could impact your ability to apply for new loans. So if you know, business loans, car loans, getting another form of credit, if they've seen that you've taken a mortgage holiday in the last few months, they may be a bit of question as to, you know, why have you done that? So that is something to be wary of when we're looking at these options. Again, always worth speaking to your other, you know, people who have hire purchases, you know, with their cars, may have personal loans. Always worth engaging with those lenders, with those providers at the moment. And if you are finding yourself in a bit of a tight spot, especially with Christmas around the corner, it's normally the most expensive time of year. See if there's any flexibility that can be done, because just freeing up a few £100s for that particular month may just really help you sort of get through some of the difficult period. So yeah, please don't be afraid to seek help and ask questions. I think is really the most important advice. The next thing really is in regards to, oh, sorry, just quick on the mortgage front. The mortgage market itself has been quite, it's been up and down, I'd say. I think obviously during the first lockdown, everything kind of just shut down. And then I think in the summer, you saw a little bit of a spike, but a lot of that was catching up on what was missed during the initial lockdown. Things have kind of quietened down now. Interest rates are still really, really low. And there are, you know, things and mortgages out there and stuff as well. So if it is something you're looking to remortgage or anything else as well, it is still something to sort of see, having a look at and see what can be done for you as well. So yeah, it's been a choppy period, but I think given the positive news over the last couple of weeks, it looks like things may be sort of stabilizing a bit more in the next couple of months. The other area I wanted to quickly chat about is about protection. Always the underdog when it comes to financial planning. People generally take some form of life cover out for their mortgage in case they were to pass away. But I must admit, the pandemic, I think, has really drawn a focus on it. People are suddenly thinking, well, what happens if I don't have income? What happens if I can't work for my business, or my business suffers a loss? Oh, excuse me. So now might be that time to actually look through your, you know, if you own your own business, if you work for a company, or if you want to, you know, cover the mortgage, or any kind of protection in place, income protection in particular, now might be the time to actually have a look and seeing if it's worth putting in place something. Because at the end of the day, the biggest asset you have is actually you. You are the biggest contributor to your wealth, to your financial living. If you can't work, if you can't do anything, then the bills don't get paid. You can't put food on the table. So actually making sure you look after yourself is just as important as insuring your house, as insuring your car. So I think it's really, I think we forget sometimes. I think we think it will never happen to us, that everything will be fine and we'll just go along life. But as we've seen with this year, you know, life can throw obstacles in the way. And so it's always worth making sure you have some form of protection in place. So just to go over some of the various protections, as I mentioned, you've got life insurance out there. Protect it, say, you know, to pay off the mortgage, so you and your family can still have that roof over your head. Income protection, particularly if you're self-employed or you own your own business, make sure that you have something in place that if you're unable to work for a period of time, then you've still got some income coming in. You can still cover those expenses, and it just takes away a lot of the stress and the strain of having to panic that you can't work and you're not sure, you know, where the next paycheck's coming in. Particularly if you're a director of a company, or you work for a big employer, ask them to look at some form of business protection. Some companies, I'm sure some of you may already do so, offer maybe some kind of death in service or group income protection, or some kind of extra sick pay. but yeah, it is worth looking to kind of reinforce those really, and make sure that you've got levels there to maintain everything. So yeah, there are various different types of protection out there, and it's really important that you look at all options, and just and again, making something that's affordable for you. And I'd always say having some protection is having no protection. So it's always an area to worth looking at. The final bit I just want to go over is budgeting and bills. Most people, I'm sure many of you at this you know, in this webinar today, you know, are pretty good at budgeting, know where all the ingoings and outgoings are, but it's always something I think you can improve on. You can always review. So, you know, always look through the direct debits, always look through everything and all your expenses that's going out. You know, you'd be surprised how many odd accounts you're still paying for, and you're thinking, actually, do I really need to pay that £9–10 a month? And it can just really help streamline everything. Shop around with all the different providers and stuff. Again, things I know that are always hammered home, always good to shop around. People say they don't always have the time. Again, situations like with the lockdown and with everything going on, you have that bit more time maybe to kind of sit down for, you know, a couple of minutes, look through and things, and say, right, where can I get a better deal from? Because it's only going to help you out in the long term, and I think particularly it will give you that better sense of control over your finances, and just reassuring that you are, you know, keeping an eye on everything as well. Budgeting. People hear the word budget, they think it's about cutting, they think it's about sacrifice, they think it's about they have to live on, you know, on beans and rice, as seems to be the common thing at the moment in one particular TV show, and you know, living on the basics. Well, actually, I'd see it more as putting your money in order, making it work for you, and making sure that every pound that you're bringing in is working for you in the best possible way. So again, some of you might have already done this, but putting the direct debits at the, you know, straight after you get paid, beginning of the month, so that they all come out. You know how much money you get left to play with. Maybe having a bills account separate to a personal account. So again, you always make sure that the basics are covered and you know how much money you got left at the end of the month. But also make sure that you pay yourself. I think, again, we kind of forget to, and we kind of think, oh, I've got to make sure that the mortgage is covered, the gas, electric, Sky, whatever, internet, all stuff you want to cover. Actually, make sure at the beginning of the month, you put that £25–30 a month away. The first day you get paid, build up a little savings pot, whether that's towards a holiday, whether that's towards an emergency fund. Again, we always stress you should have at least 3 months there of emergency, 3 months worth of income of emergency fund there. And we found, particularly some of the clients that we deal with, those who have had that have found it a massive relief to kind of have that buffer, to have something there that if for whatever reason they have been unable to work or their income's dropped, they've got something to fall back on. So, and you'd be surprised as well how really quick putting £20–30 a month away in a savings account can really build up. And once you start doing it, before you notice, you don't even notice it's going out your account. And before you know it, you've got 700 quid in the bank, if not more. And yeah, you've got some buffer there as well. So as I was saying, these things are, they may seem simple, but I think sometimes we can forget, or we can, you know, get lost in whatever else we're doing, and actually just sitting down, just reviewing it every few months, making sure that everything's all ticked up, can just help you stay on course. And whatever storm comes forward, whatever happens with the rest of the pandemic, with all the uncertainty going forward, you'll feel that sense of control that you're doing your bit, and you're sort of steering the ship, as it were, and keeping everything over. Yeah, so if you do have any questions, or you want to have any further advice on any of those issues I've touched on, as I say, please drop me an email at alexandra@vintagefinancialplanning.co.uk, or drop us a call. I will put the details and stuff in the chat. Does anyone have any questions at all?
I have two.
Oh.
So I think just going back to your point about income protection, for a lot of people this year, furlough has been quite prevalent. And if you are on furlough at the moment, does that make it difficult to get income protection?
No, because a lot of what the providers are seeing is, obviously, if you're able to afford it on a monthly basis. there are different types of income protection, so you can get, as it were, the full whack where you're covered. If you were to fall ill for a long period of time and it could never work again to the age of 65, then you would receive a payout until your retirement. But there are ways of reducing that and getting some form of cover, if not the whole amount of cover, and it's not as expensive as people think. So from the provider's point of view, as long as you're able to make the monthly premiums just like you would your car insurance or your mobile phone insurance, it is a lot more affordable than people think, for sure.
Okay, thanks, Alex. And then I suppose the other thing is stamp duty at the moment. We've got the stamp duty holiday with us until, correct me if I'm wrong, the end of March, beginning of April. And I know our conveyancing team are quite frantic with people moving. Is now a good time for people to be thinking about moving with interest rates so low and the stamp duty holiday still around with us for the next couple of months?
Again, I think one thing that of what's happened is the first-time buyer market has really dried up. There's no 95% mortgages out there. There are very few, if any, 90% mortgages out there. You can still get on the property ladder through Help to Buy or shared ownership schemes. But really, if you're a first-time buyer now, you really need almost 10-15% deposit, which particularly in the southeast, you could be looking to 20, 30, 40,000 pounds. And unless you've got gifts or some kind of deposits there from family, that's quite high for a lot of people. So we've definitely seen a drop in first-time buyers. I think people are not sure how to sort of move forward. We've seen more movement on the home movers front, as you were saying. Again, with the stamp duty exemption, people are making the most of it and saying, you know what, I can save myself quite a lot of money, 10, 15, 20,000 pounds in some cases of stamp duty. Now's a good time to move. I would say, yes, if you feel you've got the equity and if you feel you've got the income and expenses, then why not go for it? One thing I've certainly noticed is lenders have really really tightened up criteria. So they are asking, has the person been furloughed? Have they received any government grants? Because lenders want to know what the situation is. Obviously, everyone's in a different position. Some people haven't been affected at all. And so lenders are certainly being a lot more stricter in terms of their lending. It's not to say it's not impossible, but just be prepared for those extra questions, because from their point of view, they're lending a lot of money. Things are still very uncertain with unemployment on the rise. And what they don't want to do is lend to someone who's, say, still furloughed and then gets made redundant in a few months. And then suddenly they're not unable to afford a mortgage. So I would say if you feel you're in a position to move, go for it as you can, make the most of it. But as I say, just be prepared. Some of the criteria has certainly tightened up in the last few months.
And I guess, shopping around for mortgages and the best rates is something that you can help people with.
Exactly. As I say, we've access to all the various lenders and stuff like that as well.
Sorry, Paul, I was talking over the top of you.
That's okay. I was just going to add and agree to what Alex said and say, from my personal point of view, I've noticed that mortgage rates have gone up since the COVID crisis kicked in, which seems really counterintuitive that central banks have been lowering interest rates, which would usually flow through to a lowering of mortgage rates as well. But the problem is banks, with those ultra low rates, banks are really having their margins squeezed, so they're not able they need to make money somehow, and so they found that mortgage rates have been increased slightly, and that also contributes to their more stringent lending criteria, is because they're getting squeezed so much, on top of bad loans and things that people that maybe gone into more debt and have now been furloughed and can't service, with the banks struggles to keep those margins. That obviously feeds through to the mortgage as well. And actually, I had a quick question for Alex. I've got a friend, that old chestnut, who is self-employed, and his wife has been furloughed. Now, they had a mortgage offer pre-coronavirus. Their house purchase that they had lined up fell through. The offer was made before she was furloughed, and has subsequently been withdrawn because she's now furloughed and they won't re-offer. Do you have any advice as to what people in that sort of situation can do? Are there particular lenders that are more favourable?
at the beginning of the crisis, lenders were a bit more relaxed when it came to furlough. They were quite happy that if you'd been furloughed, they were saying, okay, that's absolutely fine, because it was assumed it would be a short-term measure and you'd be back to work. What I found this in the last couple of months is lenders are saying, to be honest, we really need to see that first month's pay slip back. We need to see a letter from the employer saying that they are going to come back on full pay and at least start to do that. Beforehand, they were happy with, oh, you know, you work for such and such, it's closed, but come April, May, we'll be open again. Okay, that's absolutely fine. So in terms of that situation, I think until they're back at the full-time job, and at least in the first month, and have got a letter saying, yes, we're coming back on this date and we're going to be back at full pay, then that's when lenders will consider it. But until that point, lenders are just being really cautious and just saying no at the moment on that front. Sorry, I know there was another question.
I have a question for, actually, it may well be you know, something for Paul and Alexander, but you know, I've had a few financial investors and financial planning sort of advisors come and talk to us saying, you know, if you know of any staff who received a lump sum redundancy payment, then we'd like to chat with them, you know, so we could talk about investment and pensions. And I have to say that overall, there's a reluctance in letting go of that lump sum cash for the simple reason, you know, this whole pandemic, the one thing we've heard is cash is king. And of course, on the heels of what you've been just saying, Alexander, that, you know, people who've been furloughed, getting a loan is getting trickier now. So really, my question is, what is your top tip, bearing in mind that diversity is a key to sort of maximizing your returns, but really, what is your top tip in your experience to hedge against these sort of dips in, you know, the market? Because these sort of dips are going to keep happening. But if, say, somebody needs that money today, say their child is going into university, they need that money, and it's just not worth, what is an ISA is just not worth what they had planned. What really is your top tip for hedging against that sort of dip and risk in the market, which is always going to be there?
I think it's more for Paul.
I know there's no crystal ball, but
Good question. So the first thing is, if you've come across a lump sum of money, be it through redundancy or inheritance or lottery win, who knows, any sort of coming into a large sum of money like that, the first thing you have to do is identify those goals. What is your aim for that money? If you need to use that money, so if it's going to be used on well, university fees, that's a different topic altogether, and I can't give advice, but what I can do is say, before you start paying university fees, seek advice about student loans. Because from my point, that
was just an example, but you know,
but it's a good thing to know, because student loans in particular aren't the bad debt that they get the rep for, and you're actually much better putting money towards a house deposit than you are paying student debt off for your children. But separate, that's not financial advice, but that's my personal view. But in terms of that lump sum of money, identify what it's going to be used for. So figure out what the goal is. If that goal happens inside the next 5 years, keep the money as cash, because we've seen these things roll up and down, and the market dips and the market spikes. What we don't want to do is invest your money and then in 2 years' time hit a coronavirus type crash, and then your money is not worth what you thought it was going to be. So although in the short term you miss out potentially on some return, you've got security of having that money in cash. That's the most important thing. What is your goal and what is your time horizon? If you've got longer to invest than 5 years, then, much as Alex said, keep a portion of that money in cash as a security blanket should anything bad happen. It's more important, I guess, for younger people that are working than it is for retired people with pensions, because there's more chance of your income stopping if you're working. But with 3 to 6 months of cash in the bank as a security deposit, that allows you to free up the rest of it. And if there's no set goal in the next 5 years, then look to invest. I would always say, look to get someone to do the investing for you, because they will assess your level of risk. They will look at what you can afford to take in terms of capacity for loss, and then they'll construct a portfolio of diversified assets around your level of risk, so that we can hopefully achieve where you need to be, but without creating any shocks that you're uncomfortable with. You can try and do it yourself, but if that were the case, obviously you then have to do a lot of research into what you're buying. But what you want to make sure is that you are creating a portfolio that has a mix of not only different types of, say, equity, different types of shares in companies, but you also need to create a portfolio that's got different types of asset classes in as well. So consider cash as an asset class. We include gold in our portfolios, in corporate bonds, which is slightly different to shares in companies, that's lending companies money. We have infrastructure, property. We've got a range of investments, and all of those create a level of risk that you can sit at the long term. So top tip, seek financial advice, but the top tip would be identify what that money is going to be used for. If it's needed in the short term, keep it in cash. If it's needed in the long term, then look at investing, and that's when you get into what risk can I take and what risk am I happy to take, and then seek some help in creating that portfolio around that level of risk.
Right, thanks a lot.
Thanks, Paul. Does anybody else have any questions? Katrina looks like she's about to sort of jump at the screen.
I just wanted to pick up on Paul's scenario of his friend, Alex, and the situation surrounding the wife who was furloughed. Now, obviously, for a lot of businesses, when they furlough employees, the employee just receives the 80%, and so they're on the reduced income. But there are also a lot of businesses who will top up those employees back up to the 100%. Would a lender therefore take a different view for someone who is furloughed but their salary has been topped up to 100%? Perhaps maybe that presents more as the employer's commitment to that individual, you know, to the future of them coming back into the business, as opposed to just being on 80% for whatever the period of time happens to be.
I think at the beginning of this, lenders were a bit more willing to look at it. They very much treated furlough as they would maternity pay. So they very much saw it as, oh, well, you're on a reduced income now, or you know, less, but you're going to be back to such and such. But I think as time has gone on, and as things have gotten more difficult, I think they've very much taken this kind of cautious approach of saying, unless you're back at full pay and you're not being furloughed at all, then at the moment we can't use that income. So even if they were being topped up, I think lenders have it's just been blanket across the board, because, as I said, things have constantly changed. I mean, I've never known a year where, you know, normally there's, you know, so many various deals and rates in the market, and things hardly change, but things have been chopping and changing all the time, and I think it's very much been a decision across the board. Now, that's not to suggest things may change. I mean, the new year with coming positive talk of a vaccine, lenders may start loosening up a little bit if they feel that things are coming up at the end of the tunnel. But the thing I've seen at the moment is very much, unless you're back at work receiving basic pay, or back to your normal pay, that's fine. In regards to self-employed and stuff, the grants, the lenders are happy with if you took a grant back. It's if you took a loan. So if you took that business loan that was offered support, if you're a landlord and you asked for mortgage holidays, or your rent's been reduced, lenders are really picking up on that and are saying, well, if you've asked for that, then we're going to base it at the level that you've asked for rather than what you normally get. So it's just those little things to be aware of, that if you do take those decisions, which you obviously do to, you know, either help a tenant out, or you do to try and help with payments and stuff, they may have consequences in the future in regards to further borrowing. So just bear that in mind. So yeah, that's what I'd say. That was a bit more of a general question on that. But
No, that's fine. Thank you.
Thanks, Katrina, and thanks, Sandy, for your great questions. Does anybody else have any more questions? I'm conscious that we're coming up to our end of the hour. So does anybody else have any questions?
one for Alex, really. One of my brothers he's self-employed, he took a mortgage holiday at the outset because he thought, well, it's on offer, why wouldn't I? Recently, his mortgage deal came to an end, so was looking to remortgage. And one of the questions that was asked was, have you taken a mortgage holiday? So even though he was told it wouldn't affect his credit rating, he was asked the question. He said that he had. They then refused the mortgage. And then the next one he went to asked if he had ever had a mortgage refused. So, there are consequences that people, I think, aren't really aware of. He then remortgaged with his existing lender. So, he did manage to achieve it, but he didn't realise that by accepting the mortgage holiday, that it would cause all sorts of things. And are you finding the same?
Yes. And I think it's something, as you say, people at the first instant took it as a sense of, oh, well, that's fine. That will save me £700 a month. I don't have to worry about it. And I can think about, I can just worry about getting through the next month. So my best advice would be is, if you are in that situation or you have taken those schemes, keep speaking to your lenders. And if your rate deal has expired, it may be the case that this time round it might not be the best rate, but just stay with your existing lender and sort of get back to a bit of normality for a couple of months. And then when things come around and you've gone back to paying it as normal, as it were, then you might be in a better position to sort of move around. But yes, I am finding that, and as I say, that and deposits, the biggest thing as well, with deposits now so high. So yeah, I would say the best advice: keep dialogue with your mortgage lender and see what other options are out there. They may offer you a mortgage holiday, but if you can afford to pay the interest only for a bit, say, actually, you know what, I'm happy to pay the interest only, and that way your mortgage debt isn't going up, but at the same time you're still saving a bit of money that way. So don't necessarily always jump to that mortgage holiday option. Just explore all options with your lender, and see if there's even a minimum payment or something can help.
Thanks, Liz. I'm sure there's other people like your brother that are in a similar situation, which is awful because it sort of hasn't done what it said on the tin. So I really feel for him and other people that have been affected. But great session today. Thank you so much to Alex and Paul for your present. I'm going to call them presentations, even though Alex didn't have a presentation as such. But thank you both. Thank you both for your time. And thank you everybody for joining. Tomorrow we've got the last of our sessions where the panel will be regrouping, and anybody else that's come along to these sessions this week is more than welcome to come along. Same time at 11:30. Bring a coffee. It's just going to be a really informal chat about this week and how everyone's found it and things that they're going to take away. And also a discussion if you'd like us to do a similar week at some point in the future and other things that you'd like us to talk about. But for today, I think that's everything. So thank you everybody for coming along, and hopefully see as many friendly faces again tomorrow at 11:30. Bye for now.
Alex.
Oh, sorry. I was just gonna quickly say, like me and Paul are available if anyone wants to sort of email us or drop us a message, as I say, because I know these are sometimes quite sensitive issues. So if you do have any questions at all, or know anyone that has any questions, we'll be more than happy to help and just give that little bit of advice, just as a quick end.
Thanks, Alex.